Hi, welcome. Thanks for watching and I appreciate you being here. This is one of the first videos that I'm making for the year. Although it's not exactly the first video, if you are either new here or you haven't watched the other videos yet, I want to say welcome and Happy New Year. And I hope that 2023 is going to be a wonderful year for you. Today's video is about the financial scorecard. I wanted to discuss the financial scorecard and let you know that it is an easy way to measure personal finance progression. I am going to give you an introduction to the financial scorecard, provide some definitions and the history and the origins of the financial scorecard. Then we're going to discuss the various components as well as the metrics that make up the scorecard. But first, here's a little bit about me. Hi, welcome to my channel and I'm glad to have you here. Here's a little bit about my family. Our household consists of myself, my husband, and my toddler. My mom also lives with us, but she's not included in our finances. My husband and I both went to graduate school, but we no longer have student loan debt, fortunately. I work in banking and he works in aviation. I handle all of the family's finances and I love my role as the self-appointed CFO. I love talking about all things money, making money, saving money, investing money, and optimizing my portfolio and my finances in general. I look forward to taking you on a wealth building journey with us. I hope you enjoyed the videos and the channel as a whole, and I look forward to getting to know you. I am very open, so feel free to send me messages at any time or starting conversations in the comment section below. Everyone wants to improve their personal finances, regardless of what the reason might be. Whether it is because you want to send a kid to college, you want to take care of your family, you want to take care of your parents, or you just want to have more time to yourself and either work less or retire much earlier than the average person. The concepts to achieve success in personal finances are relatively simple. You effectively have to make a living wage, you spend less than you make, you save and invest the difference, you stay out of debt, especially high interest debt. That's it. That's all you have to do. But the real challenge to having solid personal finances is in the execution. To improve your chances of success, we all use tips, tricks, and tools. I wanted to present the financial scorecard as one more option that you can add to your toolbox of tips and tricks to achieve financial success. Before I get into the financial scorecard, I have to start by telling you what a balanced scorecard is, because that is where that concept comes from. The balanced scorecard is a business concept that is used as a tool to measure and monitor performance on certain key metrics. It's a way for managers and senior leaders in an organization to help focus on the big picture, and they use 4 different perspectives: financial, customer, learning and growth, and internal processes. That is the balanced scorecard. However, there is a personal finance application to the balanced scorecard. Tracking is important for success. That's why companies track everything that they do. But tracking can also be overwhelming. In order to make it more manageable, the financial scorecard is a simplified version of the balanced scorecard concept. If you are enjoying this video so far, don't forget to hit the like button so the algorithm knows that it's good, and of course subscribe for more content. If you think any of the information that I provide here might be helpful to somebody else, be sure to share it with them. You take that and you apply it to your personal finances to help give you a full picture, and it makes it much easier for you to create a strategy. Just like the balanced scorecard, the personal finance scorecard also have 4 perspectives. The 4 perspectives that I included to this financial scorecard: liquidity, debt management, investment, and risk management. As you can see, those 4 perspectives tie right back to the basic financial concepts that you have to follow to achieve success in personal financial management. However, there is one thing you can add to your personal finance scorecard that is very similar to what the balanced scorecard has. Remember, there are 4 perspectives to a balanced scorecard, but there are also components that managers use to track their performance of their unit or their organization to make sure that they are successful in meeting their objectives. First, you have your goals. Your goals are what you want to achieve. Next, you have your measures. Your measures are how you're going to assess your progress. Next, you have your targets, and your targets are what you want to achieve and when. And finally, you have your initiatives, and your initiatives are what you will do to achieve your goals and how you will do them. Those are the 4 components of a balanced scorecard, and I decided to keep those the same for the financial scorecard because if it's not broken, don't fix it. The financial scorecard metrics, I am going to discuss and define the key metrics that are needed for success, but I'm not going to discuss the 4 components of objectives, measures, targets, and initiatives because those are too specific and the possibilities are endless. However, towards the end, I will show you an example of a summarized financial scorecard. Let's get into it. On my screen here, you should be able to see a financial scorecard table. There are 10 elements to a financial scorecard. I'm going to provide the key indicators and the definition for each of them. I'm also going to discuss why they are important to know if you are going to achieve success. The first indicator is net cash flow. That is the difference between your income and your expenses. In order to achieve success, you have to spend less than you make. Knowing your cash flow is going to help you determine whether or not you really are spending less than you make. If your cash flow is positive, that means your income is more than your expenses. If your cash flow is negative, that means you are spending more than you make. Your ideal situation is to have a positive cash flow. Next is your emergency fund. That is your liquid cash reserves. The reason why an emergency fund is important is because it helps you get through a financial crisis without having to rely on debt. I think at some point we have all heard the statistic that nearly 60% of Americans cannot meet a $400 emergency. That is a very dark statistic because it means that most, if not all of these people would either have to borrow from family or friends, or worse, they would have to possibly consider putting that unexpected expense onto a high interest credit card. Next, you should know what your 401k match is if one is available to you. Your 401k match is your employer contribution to your retirement account. There's a key factor here that you need to be aware of, and it is in the name, match. That means most of the time, in order for you to get anything, you have to put something in. That is free money and 100% return on your own money. For every dollar that you put in, your employer is also going to put in a certain amount up to a maximum. You should know what that amount is to make sure that you are at least putting in the minimum required to get as much of the match as you possibly can. Otherwise, you're just leaving money on the table. Next is your debt interest rate. Your debt interest rate is the cost of borrowing. To the lender, that is a return, but to the borrower, that is an expense. The higher your interest rate, the longer it takes for you to get out of debt, and the less money you have available going towards saving and investing. You should definitely know what the interest rate on your debt is. That way you can make sure that you get away from it as quickly as possible, especially if it is high interest. Next, you want to know your credit score. Your credit score is a numerical rating of your credit profile. That indicator is an important one to know and to maintain for several reasons, even if you have no intention of getting debt in the near future. You would be surprised how many companies and organizations that you deal with who are not borrowers but are interested in your credit profile. Insurance companies will look up your credit to determine your risk level, and they can sometimes determine what your insurance rate, especially for car insurance, what that might be based on your credit profile. A lot of employers these days are checking your credit to determine if you're a good candidate to work at their company. Personally, I work in banking. I have never had a job where somebody didn't ask me for my credit score or my credit report, or if they didn't check it in one way or another. Also, it determines the cost of your borrowing. Even though you're supposed to stay away from debt, I understand that there are some circumstances where you might have to borrow some money, or maybe you just want to borrow the money because you have a different purpose for the liquid cash that you have. Even if it is a strategy of last resort, you never want to be in a position where you have a bad credit score, because if you are in a pinch and you do need to borrow money, you want the cost of borrowing to be as low as possible. And if your credit is not good, you're not going to get the best rate available. Next is your savings rate. And the savings rate is a measure of your savings as a proportion of your income. And it is measured as a percentage. If you make $100,000 a year and you save $25,000, then your savings rate is 25%. Some people calculate it as a portion of gross income. Some people calculate it as a portion of net income. Personally, I tend to calculate it as a portion of gross income because net income is too variable given the fact that you have to account for taxes and other deductions that might come out of your paycheck. And the reason why knowing your savings rate is important is because the higher your savings rate, the less time it's going to take for you to reach financial independence. If you're saving more of your income each year, that means you're spending less of it. That means you need to replace less of your income in retirement. That also means that you are not putting yourself in a situation where you are being negatively impacted by lifestyle inflation. Either you're not raising your standard of living at all, or you're not raising it in direct proportion to the increase in your income. And if you're doing that, that means you can put away a lot more money, you can save a lot more money, and that means you are much less likely to have to scale down in an unsustainable way when you do exit the workforce, or if you want to pull back a little bit on work. Next is your net worth, and your net worth is the difference between your assets and your liabilities. That is everything you own minus everything you owe. Ideally, you want your net worth to be positive. Of course, some people do not have a positive net worth. They might have a negative net worth because they are still getting rid of their debt, or maybe they're fresh out of school and they have a lot of student loans. But knowing your net worth and tracking it is very important because you want to know how it changes year over year. If you are working towards financial independence, you are going to want your net worth to grow. And you're not going to know how it's fluctuating if you're not looking at it. It's important to know what assets you have equity in. Your house or your car, these are assets that you might have some equity in. Especially your house, most of the time your appreciating assets are where you're going to have the most equity. And under some circumstances, you might find yourself being able to sell an asset to meet your goals. You might sell a bigger house and downsize to a smaller house, or you might sell a house in a high cost of living area like California or New York and move to a low cost of living area. But if you don't know what your assets are worth and you don't know what you owe on them, it makes it a lot more difficult for you to plan ahead on these moves that might financially benefit you. Next is your target asset allocation. An asset allocation is a risk-based asset class decision. That's how you divide the different asset classes in your portfolio. Typically, people will divide those asset classes based on their risk tolerance. If you have a higher risk tolerance, you might have more equities. If you have a lower risk tolerance, you might have more bonds. If you are going to retire soon, you might have a higher proportion of bonds and cash to get you through the first couple of years of retirement in the event that there's a market downturn right when you exit the workforce. Of course, it's not just about risk, it's also about returns. High risk, high reward. If you are very young, say you're in your 20s, and you don't plan to retire until you're 60, that's 40 years of growth, and you don't want to be in a position that is too conservative, that gets in the way of you being able to make very good returns, because you do have the ability to weather the storm. Asset allocation is all part of financial planning, and that is one other indicator that you need to know about yourself. Next, what is your target wealth or target retirement balance? Effectively, that's exactly what it sounds like. That is your desired portfolio balance. What do you want to get? What is your number? Is it 1 million? Is it 2 million? Is it 3 million? Maybe you're going to retire in Southeast Asia and it's only going to be 500,000. I don't know. Whatever the case might be, what do you want your portfolio balance to be? Whether it is when you retire or whether it is when you reach financial independence. And finally, the last indicator is years to retirement. That is how much time you have left to retire or achieve financial independence. And the reason why that is important is because it ties back to your target balance. That is effectively how much time you have left to achieve that target retirement balance. That's going to determine what your savings rate should be. That's going to determine what your asset allocation should be. That's going to determine how quickly you want to get out of debt to make sure that you can redirect those funds. Because somebody who has 10 years left to retirement is going to have to make very different decisions than somebody who has 25 years left to retirement. So these are the 10 elements to the financial scorecard. But before we go, I wanted to put up on the screen an example of a financial scorecard. Here's a sample of what one might look like. These are just random numbers that I plugged in. They're not reflective of anybody I know or my own financial situation. But I thought it might be a helpful way to help illustrate what one might look like for you if you decided to make one. As you can see, this person's net cash flow is positive $300. They have an emergency fund balance of $6,000, and they have a 401k match of dollar for dollar match up to 5%. As for debt interest rate, this fictional person has 3 different kinds of loans. The mortgage at 3.5%, there's a student loan at 5%, and there's a car loan at 2%. Their credit score is 725, and their savings rate is 20%. They have a net worth of $25,000. And this is more proof that these numbers are fictional, because as a homeowner, most homeowners, not all, but most homeowners do have a net worth that is much higher than $25,000. The median net worth of a homeowner compared to a renter is actually in the six figures. As for asset allocation, you have stocks at 70%, bonds at 28%, and you have cash at 2%. I wanted to do it this way because I did want to remind people that cash is also a position. That person's target wealth balance is $1.5 million, and they have 20 years to retirement in order to achieve that. Okay, so that is it for the example of a financial scorecard. I hope you enjoyed the video, but before you go, I do want to hear from you. Are there any key numbers that you track? If so, which ones? Also, is there anything that you would either add or remove from my scorecard? And finally, besides that, looking at it overall, do you think it's useful? Let me know in the comment section below, and I will see you in the next one. I would like to continue sharing my thoughts on all things money with you. So I would appreciate it if you could help out the channel by liking this video and sharing it with anyone you think might benefit from it. If you want to see more content, be sure to subscribe and hit that notification bell so you can know when new videos come out. I'll see you in the next one.